Welcome to China Events, I am Jason. The Federal Reserve's July interest rate meeting minutes released on August 18 showed that most policymakers continued to prioritize the fight against inflation, with a few participating policymakers mentioning the risks to the economy if interest rates rise too high, and Fed Chairman Jerome Powell adding that the Fed could raise interest rates in September if the data supports it. In the 14 months since last March, the Fed has raised rates 11 times in a row, taking the 0 to 0.25% rate all the way to the rare height of 5.25% to 5.5%. In the minutes of the May meeting, Fed officials discussed and agreed that inflation continues to be too high, core inflation is declining too slowly, and core non-housing inflation is basically unchanged, so rate hikes won't stop. June meeting minutes also showed that almost all Fed officials said they would further tighten policy. Obviously, the Federal Reserve has made up its mind to raise interest rates on the road, even if this move may lead to the U.S. economy will fall into recession early. In fact, as early July, Fed Chairman Jerome Powell made hawkish remarks, saying, "The Federal Open Market Committee clearly believes that there is more work to be done and that further interest rate hikes may be appropriate." So the market already has some expectations for the next rate hike. According to the latest data released by Standard & Poor's Global Market Intelligence, 64 U.S. companies went bankrupt in July, and the total number of U.S. corporate bankruptcies in the first 7 months of this year has been as high as 402, twice the number of bankruptcies in the same period last year. The Federal Reserve continues to raise interest rates, monetary policy narrowing, enterprises from the bank cannot loan money, business will be more difficult to sustain, followed by layoffs and pay cuts, bankruptcy and closure. Since March this year, the U.S. Silicon Valley Bank and Signature Bank, after a succession of mines, U.S. banks have been thunder. In May, the First Republican Bank also due to the collapse of the capital chain rupture collapse. This suggests that if it turns out that inflation is more entrenched than expected, the policy rate may need to be raised, because the degree of slowdown in economic activity did not meet expectations. At the same time, rising interest rates will bring more pressure on banks. And just days after Moody's, the U.S. ratings agency, downgraded the credit ratings of 10 small and medium-sized U.S. banks at one time and said it may continue to downgrade the credit ratings of a number of large U.S. banks. Fitch, another U.S. ratings agency, warned on August 16 that it may downgrade dozens of U.S. banks, including J.P. Morgan Chase. Prior to that, Fitch had already downgraded the U.S. credit rating, which sparked investor concerns about the health of U.S. financial assets such as U.S. debt and U.S. stocks. Moody's said that defaults in the U.S. agency bond market will exceed last year's total in 2023, with at least 106 U.S. agencies going into trouble, which is a 65% increase from last year, as rising borrowing costs and tighter lending standards in the U.S. market put more pressure on the credit-dependent U.S. economy, suggesting that, following the U.S. debt ceiling crisis that nearly led to a U.S. default on U.S. debt, a new wave of defaults will hit the U.S. for some time. And the momentum continues, signaling a continued sell-off in the U.S. debt market. The first half of this year, the United States around the U.S. debt will default on the discussion for half a year, the U.S. bipartisan staged in front of the world, coward game. The final result is expected. The United States once again passed a bill to raise the debt ceiling, before January 2025 can be unrestricted issuance of U.S. debt. With the accelerated expansion of U.S. debt, the U.S. needs to pay interest each year has risen sharply, is expected to pay $1 trillion in interest on U.S. debt this year. Once the U.S. fiscal revenue does not cover the interest payments on U.S. debt, will inevitably lead to a default on the debt. The impact of the U.S. dollar credit system. The United States, with more than 100 years of the establishment of the hegemony of the dollar, may be heading for disintegration. When this day will come, no one can predict, but it is necessary to prepare in advance. Superimposed on the changes in the international situation, our country has been steadfast in selling U.S. debt. In May this year, we sold $22.2 billion of U.S. debt, and Japan and the United Kingdom also sold tens of billions of dollars. However, by June, Japan and the United Kingdom chose to reverse buy U.S. bonds and stop reducing their holdings, but China continued to reduce its holdings of U.S. bonds by $11.3 billion in the same month, and in the course of 2 months, China reduced its holdings by $33.5 billion. Japan has also been selling U.S. bonds in a big way since last year. Throughout the year 2022, Japan sold U.S. bonds as much as $200 billion, but Japan was to stabilize the exchange rate of the yen. This year Japan has intermittently begun to increase its holdings of U.S. bonds, holding a $1.1 trillion in the size of the position. To say that the biggest sell-off of U.S. debt should be Russia. Russia was once also the top 10 holders of U.S. debt, holding more than $180 billion, but since 2014, after Russia's large-scale reduction of U.S. debt holdings began, to 2023 Russia holds less than $100 million of U.S. debt, nearly a decade of selling off $180 billion. So, from the point of view of China, Japan and Russia's selling of U.S. debt, the greatest strength is Russia, almost clearing the position, and China's selling of U.S. debt is the highest, more than $400 billion. However, the world's largest seller of U.S. debt is not China, Russia, but the U.S. Internal Federal Reserve, which is unexpected by many people. Many people for the Federal Reserve's cognition, still stuck in the U.S. debt receiver stage, now how to become the biggest seller of U.S. debt. In fact, in 2020, the U.S. economy suffered a serious shock at the moment. The Federal Reserve Emergency Start Unlimited QE, a large amount of liquidity released to the market. The printing machine opened the floodgates, when the Federal Reserve in the expansion of the table, almost every month in the purchase of U.S. debt. However, after several years of flooding, U.S. inflation rate continued to climb high, so the Fed began the operation of interest rate hikes, tighten the market liquidity, trying to reduce inflation. The Fed began to sell the U.S. debt held in the hands of a large number of people, began the shrinkage. In June this year, the Federal Reserve sold nearly $60 billion every month in the sale of U.S. debt. Compared with the same period last year, the Federal Reserve has accumulated $600 billion in sales. The strength of this sell-off is far from China, Russia can be compared. To know, the dollar hegemony is intended to harvest the world, regardless of the Federal Reserve is to raise interest rates, lower interest rates, or expand the table, shrink the table. In the process, the power of the dollar tide is enough to pull the explosion of a country's financial markets. For our country, sitting on $3.2 trillion in foreign exchange reserves, the size of the world's first, but 26% of them are U.S. Treasury bonds, obviously not reasonable, and the risk of U.S. debt in the future is not yet known, so our country continues to reduce the U.S. debt, by other assets, such as gold. At present, our country has been 9 consecutive months to buy gold reserves, and our country is also the world's largest increase in the number of countries that have increased their holdings of gold since this year. Yellen said in an interview that it has been noted that the status of the dollar is taking a huge hit. However, she remains firm in her belief that other currencies cannot replace the dollar for the time being.